And then when they are accumulating their position, meaning buying the market, as the market runs back up, they're starting from a lower number. I mean, let's face it. If in the marketplace the buy orders were coming in at these levels here, and the market maker was starting from this level here, don't you see how price could very quickly get away from him, and he would be into this high volume area before he was able to accumulate a position? And now he's forced to sell a position he either doesn't own, which means he's short, or he's selling out of inventory that he doesn't want to liquidate. So the market maker has an vested interest in making sure that as buy orders come into the market, that price is as low as possible. So, how does this play into seeing volume come in at the extremes? Well, let's take a look at our chart and make these two things meld together. Now, in this particular chart, you can see that the Canadian dollar has actually been moving up slightly. Now, based on the hourly range, you can see that it's had several different moves, both up and down. But let's take a look at where the extremes in volume come in. Now, based on the extreme or ultra high volume, you can see that one area is here, which was on the turn. Another area was here, which was also on the turn. Let's look back a couple more bars. You can see that this area came in at the turn. Let me make it a little bit more apparent. It came in on these bars here. And this area came in here on the turn. So we can physically verify that in most cases, the high volume bar comes in either right on the turning bar or within a couple of bars. Now let's follow this along here. The first idea is just a simple exercise in logic. We can see that the market is moving up. We can see that there's high activity. Wouldn't it make sense that if all of this activity was buying, that the market would have some kind of follow-through? Would it make sense that on this high activity area here, that if all of this activity was selling, that the market would continue down? It seems to me it's just logic. If people are selling, the market has to go down. Remember the market maker. If he sees orders to sell in the marketplace, he is going to mark the price down to lower and lower prices. It's both a function of supply and demand, and it's also a function of the mechanics and the desires of the market maker to make money. Now, I promise that I'll make this whole theory come into a better view as we progress. All I want you to notice is that the volume or activity, generally speaking, comes in on the turns and not during the trend. And I just simply challenge you to verify it on your own. Go back over stocks, futures, even Forex, and look and see, when do you see the volume or activity spikes? More often than not, it's going to occur at the turn.